following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
Ladies and gentlemen, please welcome to the stage Kevin Kennedy, NASDAQ OMX.
Good morning. Hope everybody's awake at this point, and thanks for coming this early. So I'm going to introduce our moderator for the next panel, the Quest for the Holy Grail, and I did a little research. I hadn't met Mark Longo before last night. I did a little research, and what struck me about Mark wasn't that he had the first options podcast on iTunes or that he runs a great website called theoptionsinsider.com. It wasn't that he runs the world's only radio network for options users. You know, he's a journalist. He's really done a lot for our industry. He's a great asset that we have. What struck me about Mark is that he's a former market maker, and I'm a former market maker. And then I started to think there are a lot of former market makers. It's sort of, you know, one of those two words, I guess the opposite of an oxymoron, two words that just sort of roll together, former market maker. And the more I thought about that, I thought really it's indicative of what's become of our industry, which is just, you know, on the good side is fierce competition with great prices for customers and participants of all kinds. So I think, you know, we should really look forward to a great discussion on how Mark can get his participants to, and everybody here, I guess, to get people to use options even more, because I think we have a terrific product. The bid asks are tighter than they've ever been, and there's a great experience for customers. So without further ado, I'd like to introduce Mark Longo.
Thank you. Well, this is actually a surprising turnout for 8 a.m. on a Saturday morning after a night out on Friday in the French Quarter and during Jazz Fest. So thank you all for dragging yourselves in. We'll try to make it worth your while. But we're here today to talk about financial advisors. In many ways, the most exciting and intriguing and also the most frustrating new growth market for the options business. You know, it's certainly been frustrating and intriguing for us at the Options Insider to try to pin down this marketplace, this audience. We've made a lot of great strides with them over the past few years, including launching a show with the OIC on our radio network called The Advisor's Option, specifically targeted at this audience. And yet, when you look at our overall audiences for our different venues, advisors remain a mere fraction of the people who are coming to our destinations to learn about options and read about options. And so it's a difficult problem for the entire industry to crack at this point. These advisors and these asset managers really represent substantial amounts of assets that, from an options point of view, are completely on the sidelines, completely untapped. And it's frustrating because on paper they are so ideally suited for options and basic options overlays. The vast majority of them are essentially long-only equity managers who would benefit enormously from things that we would consider here relatively simple, like basic protective puts, covered calls and collars, and things like that. Yet, for a number of different reasons that we'll discuss on the panel today, they simply aren't being lured into the fold. In many ways, they are the holy grail of the options market. They're that elusive prize that everyone seems to be searching for, and yet no one really seems to be able to nail down. So that's what we're going to talk about today. We're going to talk about what is going on with this audience. Why are they still, even in this late day and age, still in many cases reluctant to come into the options fold? What are the barriers? What are the obstacles that are holding them back? And how can we address those? There's a lot to do in 45 minutes, so let's just dive right into it. I've been lucky enough to assemble a great panel to help me with that today. Starting off to my left, Randy Swan. He is the president and co-founder of Swan Wealth Advisors. Along with his brother, Robert, he founded Swan Wealth Advisors in 1997 to protect clients from large losses. They utilize a defined risk strategy, which incorporates options overlays into index-based strategies that allow investors to participate in upside movement without all of the downside risk. Before starting Swan, Randy was over at KPMG, working with domestic and offshore insurance companies. Next to him in the middle there, we have Stephen Solaka. Stephen is a managing partner and co-founder of Belmont Capital Group. Belmont was founded to apply the risk management expertise of professional options traders to investor capital. Prior to founding Belmont, Stephen was a VP of equity derivatives over at TD. He also was an equity ETF and index option market maker at a variety of firms, and was formerly a member of the CBOE, CBOT, and Amex. And then finally, on the end of the panel over there, we have Mike Cavanaugh. He is the founder of Know Your Options, Inc. KYO is an advisory firm that specializes in implementing option strategies for sophisticated retail investors. Recently, KYO merged with Sweetman Cherry Group, an institutional block execution firm serving the needs of institutional options clients. So now the combined firm really addresses the needs of both retail options clientele as well as institutional options clientele. So with the team assembled here, we're just going to dive right into it. We'll start with you, Mike, on the end there. What, in your view, are the primary stumbling blocks, the primary hurdles that are still keeping advisors from diving into the options fray?
I think the primary hurdle has always been education and perception. So the name of our firm, Know Your Options, might as well be hit me in the face with a hammer. Because when somebody hears options, they think of risk. They don't think of hedging risk. They think, I'm going to lose all my money trading options. So I think the primary hurdle of our industry to accept options is actually education.
Stephen, same question for you.
I would agree with those sentiments. Getting advisors and investors comfortable with with options and some of the complexities and whatnot is very important. They all want the return profile.
Yes.
They want income. They want all these things. But they just need to be more comfortable with with the mechanics. The other thing I would say, in addition to education, from an advisor perspective, especially at some of the big wirehouses and brokerage firms, is compliance. I have friends that work at some of the large firms. They just say, "Oh, I just can't do it. It's too hard."
From my experience, it's typically related to once an advisor has made the decision to use options for their clients, it's dealing with the different brokerage firms and custodians, that the additional paperwork, options applications, margin applications, just it's a hurdle they have to get over and decide that, yes, they're willing to spend the extra time, energy, and effort to get a better product at the end of the day.
Mike, you started off with the education, so let's start there then. That's a common refrain we hear quite frequently. We need more education for advisors. We need more education for advisors. And there's certainly no shortage of exams and certifications for advisors right now. But I think the primary question for this audience really is the existing infrastructure to bring a advisor into the fold, are they sufficient to really arm them and prepare them to start implementing options? Or is this really still the kind of thing where you have to be a self-motivated advisor and come to it on your own? I guess the real fundamental underlying question there is it time for an options certification, a separate options certification exam? I mean, we all know advisors love to have a shingle they can hang on their wall to market themselves, to separate themselves from the advisor X down the street, and if they can be the one who say, I am certified in options, that is something that they might rally around, and then that might indeed lead to more of them diving into the fold. So do you think we need that extra level of certification, Mike?
I think I'd offend half the room. I see some friends from Chicago that were market makers on the floor. I think I'd offend half the room if I said a piece of paper and a certification could make you options worthy. I think experience, maybe 5 years on the floor, probably had a lot to do with a lot of the successful advisors using options. So I think it would help, but I don't think it's the silver bullet, so to speak, that a piece of paper and a certification could be the be-all, end-all of options-worthy advisors. I think people that have been doing it, people on the floor that have done it, people, Randy's been in business since 97. Steve was on the floor. I was on the floor. I think experience probably speaks more volumes than a certification.
Still, there are a limited universe of guys like us who come from a market-making background who can then turn around and implement that in a variety of things. So there needs to be some sort of external motivating factor. Steve, do you agree with that? Do you think existing exams are sufficient and we need essentially some other stimuli to get them into the fold?
Yeah, I think at some firms, the larger brokerage firms, I think, educating advisors is one thing, but also having maybe internal designations where, like, a lot of advisors they don't feel comfortable doing this. You can educate them as much as they want, but they won't execute. They don't have the time and whatnot. But maybe having, someone within a firm saying, okay, here's you can learn about options, but having, certain teams actually manage, are they the options advisors or whatever they are. That way, they could outsource these strategies to someone internally or a third-party manager, and that's going to generate more trading, more commissions, more revenue.
Randy, what do you think about the educational aspect?
I think it's definitely an interesting idea. I would say that the motivation after 2008, 2009 is definitely there for advisors to start looking at this area because of the inherent weaknesses in asset allocation did not prove to protect clients as much as they needed to. So I think that's the first step in this process is for advisors to say, hey, there's a need, there's risk, what are we going to do about it? And then to start going down the path of learning about options, going to seminars. You can never replace the floor experience or the actual trading experience over time, but I think the first step is getting people motivated to want to move in this direction, and I think they are after the recent volatility in the markets.
So several of you have mentioned the large brokerage firms, kind of the gatekeepers, as being a impediment, a stumbling block to the expansion of options into the advisor market. So let's drill into that a little bit. There seems to be, whether it's the reticence on the part of certain brokerage firms to begin implementing options, or perhaps it's an outdated or outmoded way that they implement options into their practices. We see a lot of people pointing fingers in that general direction when you seem to say what is one of the primary stumbling blocks. And that could also perhaps address the education question as well, because if you have the evangelists and people coming from within the firms, that could also begin to push that boulder downhill, so to speak. So maybe, Randy, starting with you, what do you see some of the primary stumbling blocks, some of the major firms that are keeping advisors from really fully implementing options?
The reluctance on some of the brokerage firms to embrace options for the institutional side or the advisor side has been very difficult for us. It's definitely gotten better over the last 3 or 4 years. But as most people realize, the retail platforms to trade is much more robust than the institutional side, just because there's almost no advisors out there that actually use options. At one point, when we signed up with a new firm, they gave us a 7-contract limit. And we're like, really, 7 contracts for $100 million? That's pretty tough to deal with. So, like I said, we think there's efforts been made, but that's something that is going to have to improve in the future if we're going to get that many more advisors out there using this kind of business model.
It is amazing that there has been such an arms race on the retail side of the fence to create fantastic tools for the retail trader. Now, they can come in and essentially with a mouse click execute complex multi-leg spreads, look at analytics, things that were the domain of professional market makers not that long ago are now just included for free with a basic retail options brokerage account. And that's to the credit of a lot of the retail firms who pushed in that direction. And yet, what we've seen on the advisor side is they're not keeping pace with that. I mean, you might have someone managing, for your example, $100 million who has a far less robust system to come in and execute covered calls on that equity or put together collars or things like that. I think when people first start realizing that, it's very surprising to them that this relatively sophisticated aspect of the business could still have such rudimentary access to tools. So, Stephen, with you, I think following up on the tool segment and also the firms in general, what are some of the primary stumbling blocks you see when interacting with the large brokerage firms?
I would absolutely agree with Randy. It's interesting when you're, we use a few custodians and I'm looking at the system and CNBC comes on and there's this like awesome trading tool with all these spreads and all these things and I'm sitting there with something that's not as even close to being as robust. For a while, you couldn't put in a spread order and on the system, which is for me it's okay. I can figure it out. I can call it in or whatever. But if you're going after the advisory market, especially on the RIA side, independent side, you got to make it easy for these guys to click the button. If you don't make it easy for them to hit the button, they're not going to do it. They're not as comfortable.
You can't expect every RIA down the block to leg into their own spreads manually on every account.
But something like this. You're on the system. Guys, everyone does buy rights, cover call. I mean, that's where everyone starts, and a lot of advisors do that. Being able to pull it up and say, okay, here's the yield, and they can call the client and say, hey, listen, we're buying XYZ, and we're selling this call, and it's going to, the annualized yield is 12%, and here's the return profile. I mean, that's powerful. Because a lot of these guys can't figure that out themselves.
Mike?
A retail client comes to a brokerage firm with $100 million, I think they would roll out the red carpet. An RIA's got $100 million, they show up at the same firm, and I think there's regulations, red tape, and higher ticket charges that welcomes them. So it's absolutely an issue. I don't know if there's a solution for it in the short term, but it does absolutely feel like the retail client has an edge, a competitive edge, with tools and commission rates over an advisor with $100 million.
That is amazing that in this day and age that is still the case. Staying on the tools tip for a moment there, not just on the tool side, on the brokerage side, but we're also seeing whenever we interact with advisors, whether it's through our radio programs or through the website, and we discuss with them these topics, a common refrain we hear back from them as to why they're not implementing options is twofold. It's time, being able to manage the time to do it, and also a certain lack of scalability to a lot of the strategies that they want to implement. And part of that goes, again, to the tools. There's still a dearth of quality third-party tools that are available for your average RIA or asset manager who wants to come in and has dozens or hundreds of customer accounts and wants to implement, let's say, a simple covered call on those accounts. It's amazing in this day and age how many advisors I bump into who still are manually executing and rolling calls on each of their accounts and then tracking the whole thing in an Excel spreadsheet. That is still the main way a lot of them do their business. And here we are at a conference that is overflowing with vendors, and yet we see no one really penetrating and offering a material solution for this enormous problem that really is keeping a significant number of assets on the sidelines from an options perspective. I'm curious what you guys, maybe Randy, would think about that in terms of just the third-party tools. You're probably a good example. When you were implementing your strategy on the index, were you able to go out and buy off-the-shelf systems to implement that? Or did you have to build a proprietary system to implement it and track that?
No, just like with the custodians and the brokerage firms, we've had to build our own software, our own proprietary software to run the allocations. So when we're doing big block option trades, we get to allocate them back across, the accounts that we're doing. So there's definitely not been very much third-party software or anything out there to help us out.
You had to build a proprietary system.
Absolutely.
That's another significant stumbling block. We expect every RIA or asset manager coming into this space to have to either use Excel or build a proprietary system from scratch if they want to do anything more than 7 lots. That's going to push them in the other direction. Let's talk about the client side now here for a moment, because traditionally in years past, that's always been what's been floated out, why advisors aren't adopting these instruments on a more rapid rate. It's that the clients are reluctant, and the client could be, the proverbial Aunt Agna out in Iowa, or it could be a large pension fund. Whenever options were brought into the conversation, even in a basic hedging capacity, they would clear the room. So that was the case, and I'm curious, from your guys' perspectives, what are you seeing either on the retail or institutional side from the client perspective? Are you starting to see client demand for these products that is going to start pulling advisors in, or is it still top down from the advisor and the clients are reluctant to embrace that? Steve, we'll start with you.
Yeah, we work with quite a bit of independent wealth management firms, on the West Coast, and out there it's very client driven a lot of times, which I think is different across the country. But they have clients asking them, I read about this, or you have a 10-year equity market that's it really hasn't gone anywhere, and they're looking for solutions. They're also looking for just more proactive ways, to manage portfolios. I would say, you have a managed account with options in it, and there's a lot going on, right? You have trades, and a lot of people like that. They feel like the advisor or the sub-advisor, such as ourselves, is doing something and is being, proactive about generating income or protection or whatnot.
They like seeing that activity over and over.
Yeah. Some don't, some do. You're not going to get everyone. I would say on the institutional side, we've had a few calls that have been, I would say, more client-driven. I would say especially on the public fund side, a lot of institutions are very, consultants have been reluctant. But there have been some mandates recently, just like retail investors, it starts with the buy right. So I've seen a lot. There's been a few fairly large buy right mandates out there. So, just getting the consultants to, have a slot for these types of strategies. A lot of them say, well, I don't know where to put it. So
that is an important part of driving that demand part of the equation, that the large funds aren't out there allocating substantial portions of their funds, even 2-5%, to someone who has the relatively rudimentary level of sophistication to buy a put and sell a call. Then we're not going to see more advisors or more asset managers developing those specialties because the demand isn't still there. Mike, I'm curious, what are you seeing on the client demand side, either on the retail side or the institutional side?
Outside of everybody coming to me and saying, I went to the OIC conference, and Phil Gocki and Alan Grigoletto were teaching me options. In all seriousness, though, I talked to a lot of accountants, and outside of the cost basis reporting issue that we had last tax season, a lot of accountants have been telling me that they're seeing an influx of alternative style investments that includes options that their clients are doing. So it's absolutely out there that clients are on their own taking it upon themselves to trade options.
So what does that mean then for the typical advisor then? You think that would be in many ways a rallying cry for them. You need to keep pace with your clients lest you lose them. They go off to another advisor who has the skill set that they want and that they are developing. Is that something you're seeing now? You're seeing advisors starting to become scared for the most part, and they don't want to lose that very quality, very active client who's interested in options, so they're starting to develop the skills to keep them? Is that something you're
I don't know if scared's the right way to define it, but definitely more open to learning about options. It just makes sense that if a client calls an advisor and says, hey, I want to do covered calls, and the advisor says, well, I don't even know what that is, they have more of an incentive to educate themselves now more than ever.
I actually think they're more self-motivated right now. Obviously, clients don't like to lose large blocks of money, but advisors don't like to lose clients because they lost a lot of money. And obviously, protecting your clients from large losses in the markets is what we all do up here, really protects their book of business.
It is interesting that here we are several years past the 08-09 meltdown. We'll be seeing volatility reaching historic levels. You think in many ways, if that wasn't sufficient incentive to have, I'm sure a lot of these RIAs and asset managers had their worst years in those years, primarily because they lacked a derivatives component to provide that true level of diversification. If that wasn't sufficient to get them to pick up the phone or come to a conference like this or take an educational seminar, it kind of makes you wonder what will be the tipping points for them. What will it take, Randy, to really get them to dive in masse?
If they're not motivated at this point, due to the last 3 or 4 years, I don't think they're ever going to change. So the advisors,
they're lost to us.
The advisors that see there's a need are making that transition, I believe, and the ones that aren't are just going to stay the course and hope and pray that we don't go through another 2008, 2009 scenario.
Now, a lot of us, I think, came to the markets having been brought up in that whole CAP-M diversification model where you had 12-plus equity underlyings. You were reasonably well diversified. If you got a little crazy, maybe you added a commodity or something else to that mix, and then you were completely diversified. And what we've seen over the past few years is really the level of correlation amongst the assets has rendered that traditional style of diversification that a lot of these long-only equity managers are employing essentially moot. You have 80% correlation across a variety of asset classes. Diversification is essentially non-existent at that point. So that leads to the question then of, for a lot of these advisors who are coming and learning about these products for the first time, and we're talking to them through various means like this, do you think they can achieve meaningful diversification in this day and age for their clients without implementing some sort of derivatives component, whether it's a volatility upside hedge or some sort of S&P downside for a broad portfolio or whatever the case may be? Steve, we'll start with you.
One of the words that we always throw around is we call it diversification, because you have limited chance of achieving great success on the upside, and then on the downside, when things become correlated, you know what happens. I think, what we do is we preach, it's an extra layer, and the greatest thing to happen, I think, to the options market, at least to the individual investor, is the ETF market. So we go out and say, listen, you can buy stocks, and you can own insurance. Randy does the same thing. You do the same thing. Hey, you can. The only way to manage risk is own insurance on what you own. That's it. And I think giving them that, and then giving the clients that, say, listen, if things go crazy, they are going to be okay. I think is very strong.
Randy, you obviously built a practice around defining the risk metrics for your clients. You might be a little biased on this. I'm sure most of us on the panel are biased on this, but do you think you can really achieve that meaningful diversification without some sort of derivatives component in our portfolio in this day and age?
I do not believe you can do that. I think by definition, market risk cannot be diversified away by using different asset classes. So no, I don't think you can do that. We always talk about insuring every aspect of our life, our autos, our health, our life, our houses, but people do not really insure their portfolio, and that's kind of what we're all up here talking about is that word needs to get out. Most people historically obviously have just tried to protect their risk by diversifying other asset classes when, of course, everything goes, coalitions go to one. During market turmoil, it just makes it impossible to actually insure that risk.
Mike, same question for you.
Yeah, I think it comes down to, I'm going to beat the dead horse and say education, but being in the front lines, talking to clients, like to Randy's point, we insure our houses, we insure everything, but we don't insure our portfolios. When you tell a client that they have to use options, they feel dumb. They feel like, well, why didn't my advisor tell me this? Well, your advisor doesn't know. Oh, but I've known him for 20 years. I went to high school with him. We were on the same basketball team. Are you calling me stupid for trusting Tommy, my advisor? I really think that the education is a huge part of it, that the advisors out there, the way it stands right now, don't understand options, and they need to. And as an industry challenge, we have to figure out the way to educate the advisors at the mom and pop shops in the hometowns to make these people understand that it is not, the asset allocation isn't going to help you as much as hedging your portfolio with options.
So if it's not then the certification program for options, some sort of special shingle to kind of lure them in, and it's obviously not conferences like this, we're obviously preaching to the choir here at a conference like this, what is it, what middle ground is there then that is this magical, educational panacea that's going to bring these advisors into the fold, in your opinion?
We have to bring back the exchange floors and make them trade on the floor. No, I don't. I don't know. Experience is, in my mind, what always is the key to anything. We talk to our clients. I would be a fool if I walked up to a brain surgeon and said, "Hey, you know what, doc? I'm going to go start my own little brain surgery shop across the street." Well, and the guy would look at me and he would say, well, don't you need an MD? Nah, I'm just going to do it anyway. Mike Cavanaugh, MD. Same thing. You know, the entry barriers aren't as visible for either a retail investor or an advisor that wants to trade options. The entry barriers aren't clear, but they exist. In 10,000 hours of experience, I think outweighs anything in a book, anything in real life. I don't know how to do it, but I don't know how to do it.
The difficult approach to scale, I think, to have all of them come to the floor and have 10,000 hours of market making experience, as nice as that might be. So maybe Steve, then, you're another former market maker like ourselves, and what do you think then is that additional step we need to take somewhere between certification and kind of doing what we're doing now? There are so many resources, so many promotional budgets in this space, all being diverted towards advisors, yet we're seeing this trickle coming back the other way. What educational magic bullet is there that's going to open up those floodgates and send them roaring our way?
You know, I think it is education, and we talk about education, but I think the biggest thing, like anything, is convincing people that it's going to make them more money. It's going to get them more clients. You know, there was a great study that the OIC put out. It's the Belmont study, I believe.
Yes.
Yeah, and it's, you know, option investors have more money and are better looking and whatever else, but all these great things, but it is true. And I actually sent it out to a bunch of advisors and said, listen, you know, these are the types of clients, you know, that want options, that attract options. So listen, either educate yourself and do it yourself, or allocate to someone that knows how to do it.
And that's true, man. It is a much sexier clientele. They have much more assets under management, or assets to offer under management. There are many more darts per day. You know, they're much more educated. They do all the things that you would think a typical advisor would want in a client.
Right. And in the study, the larger an advisor was, the more. I mean, I think the higher percentage of them used options.
I would add that whatever education the advisor gets needs to include some education that includes options, and that it is okay to come out in the option water. I think that's really the biggest thing. It's not about these guys having to become an expert at option trading or what it is. It's just taking away that fear of we're moving in a herd, and as long as I'm in the herd, I'm okay. But if I venture outside the herd, I'm probably going to get taken out.
So maybe then it's just a question of, like we said, maybe stepping back a bit from the full court press of creating this option shingle. Perhaps it's a question of going back and inserting a few more pages, a few more lines of option-specific education in the CFA, the CFP exams, because obviously what exists right now is not sufficient to bring them over to the dark side in any way, shape, or form. So maybe that's a manageable short step in the near term, is to be able to add a few more questions, paragraphs, pages, whatever the case may be, detailing this specific subject, to at least when these new waves of advisors are coming out of their exams, they have a little bit more of an inkling of what this product is, how it works, and how they could implement them, exactly like you said, Steve, to attract more clients and make more money at the end of the day, because that's what they're all looking to do. I know we're a little screwy on time here because we started a little late. I don't want to push over into the next panel, so maybe we'll start rolling through with some conclusions. If you have some questions in the audience, you could start mulling over them now. Maybe we'll have time.
I want to say something to your point there. I started in the business in 1998 as a floor trader. When I left the floor, you know, it got weird with electronic trading, so I left and started an RIA. I've never bought a mutual fund for a client or for myself. When I say that to most advisors, they're like, well, what do you mean? I'm like, well, what do you mean? What do I mean? I've never bought a mutual fund. And I think, if you have questions, if something doesn't make sense, follow the money trail. I think a lot of it, people not getting into options, has to do with there's no true incentive for the client monetarily, or for the advisor monetarily, to just hedge, other than the right way to do business. I think Randy mentioned it before. It's an actual business hedge that when the market's down 40% like it was in 2008, I think we were down 2.5% for our clients. We weren't facing the same problems most advisors were facing, that, oh, we're down 40% and we're going to have to drop fees to make more money, whatever it is. I think there's an incentive-based issue that long term, if I'm an advisor and I align my goals with my client's goals for the long term, I can take care of myself. There's no short-term incentive, but there's long-term incentive. And I think that has to become part of the education process, that if you want to do business the right way, you want to connect with your clients and make sure your goals are aligned and you can make money together for the long term, that has to be part of the education process.
That's true. If you look at everyone's favorite these days, and I'm sure in a lot of advisors' clients' accounts, Apple, that stock has been essentially straight up for the past couple of years, and yet for the responsible advisor looking to implement options on that and buying protective puts, I'm sure, and you've experienced this over there yourself, Mike, it's been a regular stream of, why are you wasting my funds on these protective puts that are going out worthless every quarter or every month, and even if you collar it, you still have a dramatic outlier, you're clipping the upside. So there is, on that level, there is that lack of incentive for some of the advisors who may want to implement these strategies but see them on some of these underlyings that they're particularly favorable on, reducing their overall turns as opposed to maximizing them. So I think, as we'll start to conclude here and give our listeners here who are nice enough to drag themselves in at 8 o'clock in the morning here on a Saturday in New Orleans, let's see if we can leave them with some takeaways for, what we really think here are the most important and pressing concerns that need to be addressed right now, that can be addressed in the near term for advisors, and what we can do in the near term to really address them and start to increase that trickle into a flood. Maybe, Randy, I'll start with you.
I think that as there's more firms that are doing things like us up here, and there's more track record and more visibility, and we're launching a mutual fund hopefully in July, I think that's going to start hopefully to move from a trickle to a steady stream at least. So I just think it's a matter of getting out in front of people, having more visibility of what we do, having actual experience and track records to be able to show people. I think that's going to make it's going to work.
So continue to beat the drum and continue to get out there and do the in-person hard lifting of educating one advisor, one pension fund at a time. Steve, same question for you.
Yeah, I think, firms getting out there and really, there have been some firms that have been very, very helpful in introducing, other advisors, and some of them that we work with, to options. I think, options as a whole, 10 years ago, no one talked about the VIX. Everyone talks about, it's like my grandma talks about the VIX now, which is great. You go on TV, there's, options. So I think, just firms getting out there and partnering with, advisors that use options or third-party managers that use options in bringing them, into the fold.
You hit on the third parties. Maybe we'll hit on that really quick before you wrap up then. You mentioned before, too, these consultants, in many ways, the intermediaries between the large funds and options. These are kind of the gatekeepers. You deal with them on a regular basis there, Steve. What is your perception? Are they starting to come around to the dark side, so to speak? Are they starting to be more apt to recommend to their large pension fund clients that, hey, you should allocate 5% to a protective defined risk option type management series, and here are the people who can do that?
I think like most new products or perceived new products, it's always a lot of times it's the client that says, I want this, because a lot of it's status quo, a lot of gatekeepers, it's perceived career risk. They don't want to, rock the boat. They're collecting their fees. They don't want to, something new. But when a plan says, listen, I want to do this, I had, one incoming call from a consultant. I said, listen, I need some education. My guys want to, look at this stuff. Can you help me?
So a lot of the intermediaries and the gatekeepers, you're saying, are still reluctant to bring up the dreaded D word to their clients, lest they scare them all
like he
off.
said, it's like, why change? It's like, it's not going to make, it's incentive. It's not going to make you any more money.
Yes.
I've actually seen a change in the trend. I've always viewed the stock market as a vehicle that exists to hedge risk. And, most people are like, no, I want to make money in the stock market. No. The stock market exists because in a pensions case, it's very clear. You have entitlement risk. You have to pay the people that used to work here when they retire. So options actually provide probably one of the best vehicles to hedge entitlement risk in a pension. And recent developments I see out there, there's a company in Portland called PCA, Pacific Coast Alliance or Pension Consulting Alliance, something along those lines. They just consulted with the Seattle County Employment Teachers Pension, CSEPers, not CalPERS, but CSEPers. It's a $13 billion pension, and the PCA helped them allocate 10% of that to a covered call allocation. So there's definitely a movement towards hedging entitlement risk in a pension with options.
So that's important because, like I said, that gets back to the demand part of the equation again. If these large funds aren't demanding it and aren't in turn allocating substantial resources to people who have the expertise to manage that and, you know, buy the downside puts and write the calls and what have you, then we're not going to see more advisors stepping up to the plate and learn and developing those skills because they're not seeing the assets flow in.
I was going to say that I think that with the interest rate environment we're in right now, I think the options is what most of these firms can use to generate some yield.
Yes, I mean, exactly. I mean, and here we are, effectively 0% interest for all intents and purposes. So be able to generate that basic covered call or some other income generation strategies, that should be attractive. I know we have to wrap up pretty soon. So, Mike, same question to you. Bring us home here. I know you've been hitting on the education mantra. Is that the single focus of what we can do going forward, or is there some other magic bullet lurking therein?
I don't think there. I know the name of the panel was the Holy Grail, silver bullet. I don't think there is a Holy Grail or a silver bullet. And I don't think at an 8 o'clock start time in New Orleans in a panel, we're not really going to really dig deep into all the issues, and an hour is never going to be enough time. But
no, this is a day's worth of discussion.
Yeah, years worth of discussion that why options are essential to helping people. You know, I keep going back to what Randy said. Like, we insure our cars, we insure our health, we have disability insurance. We get scared about everything, and then where we have, you could argue real estate or our investment portfolios, where we have the most skin in the game, we go, no, I just want to make all this money in the stock market. And we don't hedge our portfolios. It blows my mind, but I can see the clock. We've got 4 minutes and 24 seconds left. I really don't think in 1 hour with, Randy's 15 years of experience, Steve's 15 years of experience, my paltry 12 years of experience, that we could actually cover everything that you need to know in 1 hour. So I don't know. I know your website does a lot of great things with the advocacy for the right way to do options business. I don't know all the right answers. I know that what Alan Gregoletto and Eric Cott did on the other side of this conference with the wealth advisors, we need industry professionals that understand the right way to use options to speak about it in a venue like this.
That's true. This is one of the first times we really have a cohesive effort like what the OIC is doing, spearheaded at this audience with resources and time and personnel to really go after. And we've seen in the past trickles here or there from various firms. There's an advisor team here at Firm X. There's an advisor team here at Firm Y. But now, given what the OIC is doing, that's a nice rallying point for other firms to come in and add their resources, add their manpower, and be able to make a collective, cohesive push into the advisor market and try to bring some of these untapped assets into play from an options perspective. I think we have a couple more minutes. Really quickly, if you have any questions out there, we could dive into them. Raise your hand high because these lights are blinding. We can't see you at all. So you're there in the front. Please speak up a little bit. It's hard for us to hear you up there. Just shout at us. We're not shy.
Suggestion is as follows. That the exam be one of putting it to the person taking the exam. You are in a position, you're an investment advisor, and the customer is interested in this particular type of industry. He may work at that industry, he may have some knowledge in it, but he has very little knowledge of the stock market. And give them a very specific, you are the advisor to this customer. And therefore, he comes in and he wants to do something with a particular security. Okay, you as an advisor show him what happens with his investment over time with options and without options. The customer wants to be invested in that particular security. He gives that as advisor, but he needs advice on how to handle the options so that over an extended period of time, I'll give 5 years or something, and show him a practical advantage. And I think that's the way to really get the large investors which are sitting on the sidelines. Because to be honest with you, they're afraid of options because they've heard all the bad stories of speculation in the option market.
That's true. We didn't have time to get into all the salacious stories that go out there and infect the heads of the advisor. But that is a great suggestion, perhaps more practical style of questioning and exams to allow them perhaps lay out, here's your bullish scenario for underlying X, here's your bearish scenario, here's your perhaps stay the course type of vacillating scenario, and how you can implement options in all of those, how they should perform and how they will compare and contrast just to, let's say, a long equity in that sort of scenario. You're right, that's something like that could maybe help prepare advisors a little more for the practical elements of implementing the product in their portfolios. Thank you for that. Any other questions? Or
I'd like to comment to that too. I think it's a great suggestion. We were actually talking about that yesterday on the podcast, that stocks are binary and options are nonlinear, crazy vehicles that things go on that people don't understand. But nobody talks about stocks as having a one delta. If we talk about, hey, I own 1,000 shares of Microsoft, I'm long 1,000 deltas. Nobody says that in the investing world. So if you put on a sheet of paper, I'm long the stock, here's what happens when it goes up, here's what happens when it goes down. I'm long the in-the-money call, here's what happens when it goes up, here's what happens when it goes down. I think that definitely helps in the education process. A comparison of here's what I'm used to and here's what I'm doing now. So good point.
I want to say, we live in Houston, and we have people that have invested in the oil industry for a long time, and at first they thought we were nuts when we asked. But your comment that this reduces their risk and all, I worked with an 82-year-old woman who had the nerve in the 87 crash to add to her Exxon position but she had options written on the portfolio. So it works, and I love that idea that the stock market exists to reduce risk. Is that what you said?
It's a vehicle to hedge risk.
Okay.
over here in the front.
This one's going to blow your mind, people.
Appreciate the panel, especially this early in the morning. You know, some of the takeaways we got from the Wealth Advisor Conference yesterday, and we're always learning, OIC is always learning from the advisors as well, is good points about the software. That's a barrier for sure. You know, a lot of the advisors, and we had advisors with assets under management that range from $200 million to $1 billion. These are very, very busy people. So while they want to learn about options, they certainly want to be conversant on the topic with their clients. It's difficult for them to do it on a large-scale basis. So they may do it sporadically, covered call, protective put, collar strategy, but what they're looking for is a solution where they can do this on a perpetual basis. And that's where they're reaching out is, you know, who are these people that can put these perpetual collars on for my clients? Because they're representing clients that have concentrated stock positions that are enormous. You know, they might have an executive of an oil company who has 300,000 shares of free and clear stock. That's basically short of put. So that's not so much a question as a comment. Do you perceive that that's the best way to go is to say, yes, educate them, but also maybe introduce them to former market makers who have the skill sets to set up RIA practices to help them manage the risk?
That seems to be, like you said, in lieu of developing the tools and all the things that are missing, that seems to be, right now at least, the best course of action. I don't know if Steve or Randy, if you want to dive in on that as well.
No, I couldn't agree more. I mean, that's what our business is all about, is helping advisors like that take, a certain percentage of their assets and do the perpetual collar, which is what our firm basically does with some option income overlays.
Yeah, I think getting help from either custodians or the brokerage firms, wherever the advisor is, in highlighting these firms or capabilities within a firm to do that. I mean, it just, from a custodial base, it just makes more money. I mean, these accounts, the return on assets of the options account from a custodial basis is much, much higher than just a traditional, mutual fund account.
There are vendors in the room. Take note, this is an enormous untapped market that is going completely unfilled. So we need some people to step up and provide those third-party tools to help facilitate that type of process. And I think with that, that's about all the time we have. I'd like you to join me in thanking the panel and yourselves for showing up this morning. This is no mean feat.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.